Welcome to The Deep Dive, the show that, well, extracts the most important nuggets of knowledge from a whole stack of sources.
Okay.
We try to give you a shortcut to being truly well-informed.
That's the goal.
And if you're a young professional, or really anyone stepping into new financial responsibilities, you probably know this feeling. The sheer amount of financial advice out there, it can be just overwhelming.
Oh, definitely. You've got countless articles, apps, all these gurus online, all wanting your attention. It's a lot to sort through.
It really is. And that volume, it can quickly lead to analysis paralysis, right?
Yeah.
Makes it tough to even figure out where to start.
Exactly. So our mission today is to cut through some of that noise. We want to offer you a clearer path through this jungle of financial literacy and investment strategies.
Right.
We've been sifting through a mix of sources, looking at foundational concepts, specific investment options, practical planning tips, the whole package.
That's right. We want you to walk away from this deep dive feeling, empowered.
Right.
Not overwhelmed. Ready to actually take action and take control of your money.
Mm-hmm.
So this deep dive is really tailor-made for you, whether you're trying to build that crucial emergency fund.
Super important.
Or maybe saving up for those medium-term goals, like a down payment on a house.
Yeah, the big ones.
Or even establishing that long-term wealth that paves the way for real financial independence down the road.
It's all about setting your money up to work smarter for you and doing it right from the start, if possible.
Okay, let's unpack this then. We're starting with laying that crucial financial foundation. I like to think of it like building a house, right? You need that solid groundwork before you put up the walls.
Well, good analogy, yeah.
Our sources, they really highlight three main financial goals for young people. First, building emergency savings.
Yeah.
Second, aiming for those medium-term big purchases we mentioned, like the house.
Right.
And third, creating that long-term retirement wealth.
And what's really fascinating here, I think, is how much our values, our personal happiness really shape these money decisions. It's not just a numbers game at all.
No, not at all.
It's this constant balancing act, isn't it? Between, immediate gratification, wanting something right now, and your longer-term goals.
Mm-hmm.
And every financial choice you make, it comes with an opportunity cost. That's basically what you give up by choosing one thing over another.
Right. You buy the fancy coffee, you give up saving that $5.
Exactly. And it's so important to consider those future trade-offs. That daily coffee habit seems small, maybe insignificant, but over decades, its opportunity cost could actually be a pretty significant chunk of your potential retirement savings. It adds up.
It really does. And think about all the things constantly influencing our money decisions every day.
Yeah.
Like aggressive advertising, maybe subtle peer pressure, or those really tempting sales incentives.
Oh, yeah.
Everywhere.
Our sources really push for self-awareness here. As a consumer, are you buying something because you truly value it, or did an ad just manufacture a desire you didn't even have 5 minutes ago? That's a great question to ask yourself. And remembering that money, fundamentally, it's just a tool. It's purchasing power. What it can actually buy is directly affected by prices and, crucially, inflation.
Inflation, yeah. The silent killer of savings.
Right. If prices go up by, say, 3% a year, that cash you have sitting in a checking account, it's effectively buying less and less over time. It's losing value.
So doing nothing is actually going backward.
In real terms, yes. And that's precisely where budgeting comes in. It's not about restriction, like so many people think. It's actually a proactive plan.
Okay.
A plan for managing your income and your expenses, usually month by month. And ultimately, that gives you more financial freedom, not less.
That's such a key mindset shift. Freedom, not restriction. So what are the key tips from the sources on budgeting effectively?
Well, they're pretty straightforward, but powerful. First, set realistic savings goals, something achievable. And maybe most importantly, really commit to paying yourself first.
Ah, the classic. Explain that one.
It just means you automate it. You set up transfers to put money into savings or investments before you even get a chance to spend it on other things. Treat it like any other bill.
I love that principle. It's simple, but it's kind of a profound psychological hack, isn't it?
It really is.
People often find they don't even miss the money they save this way, especially once it becomes a habit.
Exactly. And the sources also strongly recommend tracking where your money goes. You'd be surprised, maybe shocked, how quickly those small, untracked expenses add up.
Like subscriptions you forgot about. Or maybe too much takeout.
Precisely. Those little leaks in the boat. Once you actually see where the money's going, you can spot those financial blind spots. Then you can identify areas to maybe cut back if you need to.
Makes sense.
Building that budget and then actually, trying to stick to it consistently. It provides an incredibly clear picture of your financial situation. And that clarity is just, profoundly empowering.
It absolutely shifts you from being like reactive with your money to being truly proactive. Okay, so foundation laid, budget in place. What's next?
Well, the natural next step is to make your money actively work for you through saving and investing.
Right.
And for young professionals, your greatest financial asset isn't necessarily your current income or even how much you've saved right now. It's something far more valuable and often really underestimated.
Which is time.
Time, yes. And this is where the magic really starts to happen, isn't it?
It really is.
Our sources emphasize the magic of compounding interest and also dividend reinvestment. These are like proven tools for maximizing long-term investment growth.
Yeah, let's break down compounding a bit. Instead of just a simple example, think about the rule of 72. It's a quick mental shortcut.
Okay, I like shortcuts.
You just divide 72 by your expected annual rate of return, and that tells you roughly how many years it'll take for your investment to double.
Oh, cool. So if I earn, say, 8% on my investments.
Right. 72 divided by 8 is 9. So your money could potentially double in about 9 years.
Wow.
And starting early means your money doubles, and then those doubled amounts double again and again over decades.
Yeah.
It snowballs. It's genuinely remarkable how even like relatively small, consistent amounts saved early can just balloon into significant wealth because of that compounding effect.
It's the most powerful force in investing, arguably. Now, when it comes to the actual vehicles, the types of investments our sources advise, differentiating based on your specific goals and your timeline.
Okay, so let's start long-term. Retirement. For many young professionals, that's like 30, 40, maybe even 50 years away.
Exactly. So for that really long time horizon, the primary objective should probably be growth. Maybe even aggressive growth, depending on your comfort level.
And that long timeline allows you to take on, quote, reasonable risks, right? Because you have plenty of time to recover from any market bumps along the way.
Precisely. Market downturns happen, but over decades, the trend has historically been upwards, so you can ride out the volatility.
So for that long-term growth, what are some of the key investment vehicles young professionals should definitely know about, and why are they effective?
Well, the sources point strongly towards equities. That means things like individual stocks, though that takes research.
Right.
Or, more commonly, stock mutual funds and exchange-traded funds, or ETFs. These give you diversification instantly.
And they really highlight company 401k plans too, especially if your employer offers a match.
Oh, absolutely crucial. That employer match is literally free money. Never, ever leave that on the table if you can help it. It's an immediate return on your investment.
Plus, the contributions are usually pre-tax, right?
Yeah.
So it lowers your taxable income now while you invest for later.
Correct. Big tax advantage there. And if you're self-employed, or maybe you just want more control over your investments than your company plan offers,
Yeah.
individual retirement accounts or IRAs are excellent choices. They offer a really wide range of investment options, and you get significant tax advantages too, depending on whether you go with a traditional or a Roth IRA.
Okay, Roth versus traditional IRA. That's maybe a topic for another day, but good to know they're out there.
Definitely worth researching. You could also explore things like real estate investment trusts or REITs.
REITs. Okay. How do those work?
They basically allow you to invest in a portfolio of income-producing real estate, think apartment buildings, shopping centers, office towers, without actually having to buy and manage the property yourself.
Ah, so like a mutual fund, but for real estate.
Kind of, yeah. It's a way to get exposure to real estate and diversify beyond just stocks and bonds, potentially earning income from rents as well as appreciation.
Interesting. Okay, let's shift gears. Medium-term goals.
Yeah.
Like that home down payment you might need in, say, 5 to 10 years, or maybe saving for grad school.
Right. Shorter time frame.
Our sources are pretty clear. Don't just let that money sit in a low-interest savings account, losing purchasing power to inflation.
Please don't. Yeah. You can definitely aim for better returns, but you also have to be a bit more careful with risk because you don't have decades to recover from a downturn.
So what's the suggestion there?
Well, for these shorter but still multi-year goals, investing in diversified ETFs is often a strong recommendation.
ETFs, again. Which kinds?
Specifically, ones that track broad market benchmarks like the S&P 500 or maybe the NASDAQ 100.
Why those?
They typically have much lower fees than actively managed mutual funds. And honestly, over the long run, These index tracking ETFs often outperform most active managers who are trying to pick individual winning stocks.
Okay.
Plus, you get instant, broad market diversification with just one investment.
Low cost, diversified, follows the market. Sounds pretty solid.
It's a very sound strategy for many goals. And if you allow the dividends and any interest generated by these ETFs to accumulate or reinvest them, you can potentially reach your financial goal much faster than just saving cash.
Got it. And what about super safe options, if you absolutely cannot risk losing the principal?
Well, for very specific goals like higher education expenses, U.S. savings bonds are often mentioned. They're considered the gold standard of safe investing.
Okay, but the returns are probably pretty modest.
They are modest, yes, but the interest earned can sometimes be tax-free if used for qualified education expenses, which is a nice little bonus. Safety comes at the cost of lower returns, usually.
Right, that risk-return trade-off again.
Yeah.
Okay, now let's talk about the big one. Home ownership. It's often presented as the essential investment for young people.
Big American dream.
It certainly is. And traditional wisdom often dictates that, yes, a house is a good long-term investment, builds equity.
But I sense a but coming.
Well, our sources add some really crucial context that sometimes gets glossed over. Your actual financial return on owning a home is highly dependent on several variables. It's not automatic.
Okay, like what?
Like how long you plan to live there. Ideally, longer than 5 years is a common rule of thumb.
Yeah.
Otherwise, transaction costs, realtor fees, closing costs can eat up any potential gains.
Ah, good point. What else?
The housing market conditions when you buy and when you eventually sell. Are you buying at a peak, selling at a slump? That matters hugely.
Also, the interest rates you're paying on your mortgage over the years. And even what comparable rental prices are in your area. Is it actually cheaper to rent and invest the difference? Sometimes it is.
Wow, okay. So it's not a guaranteed windfall by any means. It's a really strategic decision that needs careful thought, not just like a life milestone to check off.
Exactly. It can be a great investment, but you need to weigh those factors.
This all ties into something bigger, doesn't it?
Yeah.
Our sources point out how our individual savings actually fuel the entire economy.
Yes, this is a fascinating connection. When you save money in a bank or you invest in bonds or stocks, that money doesn't just like sit in a vault.
Right.
It gets lent out. Banks lend it to businesses or individuals. Money invested in bonds, funds, government projects, or corporate debt. Money in stocks provides capital for companies to grow.
So companies use that money for what? Building new factories, research and development, hiring people.
All of the above. Investment leads to economic growth, job creation, innovation, and ultimately increased societal well-being. So when you're being smart and disciplined with your savings and investments,
I'm actually helping the whole economy grow.
you are. It's a huge ripple effect. Your personal financial discipline connects directly to collective prosperity. It's kind of cool when you think about it that way.
That is cool. Okay, sticking with individual actions, it's vital for young professionals to really internalize some core investment principles.
Absolutely. The fundamental rule, the one everyone kind of knows but maybe doesn't fully appreciate, is simply low risk will mean a low return.
And the flip side,
Higher potential returns almost always come with higher risk. There's no free lunch in investing.
people know this intellectually, but it's hard to stick to sometimes, right? Especially when markets get really crazy, either euphoric or panicked.
Very hard. Emotions are the enemy of good investing, which brings us right to another primary rule: diversification.
Don't put all your eggs in one basket. The classic advice.
It's classic for a reason. It means deliberately mixing different types of investments in your portfolio, things that don't always move in the same direction.
Like mixing fixed income, maybe bonds with equities, like stocks.
Exactly. Or different types of stocks, large companies, small companies, international stocks, or adding some real estate like those REITs we mentioned. The goal is to lower your overall portfolio risk.
You just have to think back to things like the dot-com bust, or maybe the recent crypto craze.
Right. Many people who put all their savings into one specific high-flying asset learned that diversification lessened the hard, painful way. Diversification helps smooth out the ride, makes it less volatile.
Okay, super important. Now let's shift to another really crucial pillar. Managing debt and building credit wisely.
Yes, equally important. People borrow money for lots of reasons, right? Big purchases like a car or a home are obvious ones.
Sure.
But also maybe to cover emergencies or seize an opportunity like starting a business, or even just for the convenience of using a credit card for everyday purchases.
But the danger zone is uncontrolled debt. that can be absolutely crippling.
Oh, immensely so. It causes huge stress, anxiety, and it can make it completely impossible to save or invest for your future. You're just running to stand still, paying off interest.
Our sources touch on different types of debt. Credit cards, obviously, store charge accounts, consumer loans, mortgages, business loans, they all have different characteristics.
And different costs. Understanding the true cost of borrowing is just paramount. It's not only about the interest rate they quote you.
What else is key?
The total borrowing cost depends crucially on that interest rate and the length of time you take to repay the loan. The longer the repayment period.
The more interest you pay overall.
Exactly.
Yeah.
Significantly more. Often. Think about a 30-year mortgage versus a 15-year mortgage. The monthly payment on the 30-year is lower, which feels easier,
Yeah.
but you end up paying far, far more in total interest over the life of the loan compared to the 15-year option.
That's a huge point and probably often overlooked when people just focus on the monthly payment.
Very often. Our sources also stress the undeniable importance of a down payment.
For things like a house or a car.
Right. The larger your down payment, the less money you have to borrow in the first place. And that means lower total interest costs over the loan's term. It saves you money immediately and long term.
Makes sense. Less borrowed, less interest paid. Simple math.
Simple math, big impact. And crucially, always comparison shop for the best interest rates. Don't just accept the first offer you get, even from your own bank.
Why not? Loyalty doesn't pay.
Not always, no. A small difference in an interest rate, even like 0.5%, can save you thousands or even tens of thousands of dollars over the life of a long loan like a mortgage. Shop around.
Good advice. Comparison shopping is a pretty simple step that can yield really significant savings. Okay, now let's talk about building a strong credit rating. Lenders use these 3 C's, right?
Yes, the 3 C's of credit worthiness.
Yeah.
Capital, character, and capacity.
Okay, let's break those down quickly. Capital.
That's what you own, your assets. Things like savings, investments, maybe property you already own. It shows you have some financial backing.
Got it. Second, character. That sounds a bit judgmental.
Maybe a little, but it's really about how responsible and reliable you seem. Lenders look at things like your job history. How stable is it? How long have you lived at your current address? And of course, your past payment history on other debts. Do you pay your bills on time?
Okay, basically, are you trustworthy?
That's the essence of it, yeah. And third, capacity.
Capacity too.
To actually afford the payments. This is based on your income compared to your existing expenses and debts. They want to know if you have enough financial wiggle room to comfortably take on this new debt payment.
Right. Your debt-to-income ratio is a big part of that.
Exactly. So your credit rating, which is built up by consistently repaying your debts and bills on time, is just critical. It directly impacts your financial future in so many ways.
How so? More than just getting approved for loans.
Oh, yeah. A good credit rating doesn't just open doors. It literally saves you money. You'll qualify for better loan terms, much lower interest rates on mortgages and car loans, sometimes even better rates on things like car insurance premiums.
Wow, I didn't know about the insurance link.
Yeah.
So, what are the key tips for building and managing good credit?
Well, number 1 is obvious but crucial. Pay your bills on time, every time. Especially credit card balances, try to pay them in full each month if you possibly can to avoid those killer high interest charges.
Right. Credit card debt is notoriously expensive.
Extremely. Also, actively check your credit report regularly. You can usually get free copies once a year from the major credit bureaus. Check for errors. They're more common than you might think, and they can hurt your score.
Good tip. What else?
Remember, never borrow more than you can truly afford to repay comfortably, even if a lender approves you for a higher amount. They don't know your whole budget.
They're looking at their risk, not necessarily your overall financial health.
Precisely. Always understand the loan agreement before you sign anything. Read the fine print. Understand the fees, the penalties, the terms.
Don't just sign on the dotted line.
Please don't. And finally, try to avoid accumulating too many credit cards. It just makes it easier to overspend and harder to keep track of all the payments and due dates. Keep it simple.
Yeah, sound advice. These simple habits, done consistently, really create that strong, resilient financial foundation we've been talking about.
Absolutely. Okay, finally, let's touch on protecting the assets you're working so hard to build and then planning for that long-term goal of financial independence.
Okay, protection first, insurance.
Exactly. Insurance is a critical and honestly often overlooked part of solid financial planning. It's there to protect you against unforeseen risks, things that could wipe out your savings or assets.
Like what kind of risks?
Well, think about a major car accident, an unexpected serious illness that prevents you from working, damage to your home from a fire or a storm, or even liability if someone gets injured on your property and sues you.
Yeah, stuff you hope never happens, but could be financially catastrophic if it did.
Precisely. Our sources differentiate between general insurance that covers things like your property, your car, and life and health insurance, which is more about protecting your income, your ability to earn, and providing for dependents if something happens to you.
And the cost of insurance, it varies a lot, right? Based on what?
It depends on factors like the value of the asset you're insuring. A more expensive car costs more to insure, and also your personal risk history. For car insurance, your driving record is huge. For life insurance, your age and health matter. It's all about the insurer assessing the probability and potential cost of a claim.
So it's about mitigating those potentially huge financial disasters, paying a smaller, predictable premium to avoid a potentially massive, unpredictable loss.
That's the core idea, transferring risk. And this leads us nicely into the broader, really empowering concept of financial independence.
Right, shifting the mindset from just retirement, like this mandatory stop date way off in the future,
Yeah, often seen negatively.
to thinking about reaching a point where you have the choice. The choice to work or not work based on what you want to do, not what you have to do.
That's it. It's a shift from a perceived endpoint to a liberating possibility. Financial freedom.
So looking towards that future, what are the potential non-work sources of income people can plan for to achieve that independence?
Well, first and foremost, and most powerfully for most people, your accumulated savings and investments. That's the engine.
The portfolio you build over time.
Exactly. The cumulative power of saving early and consistently, harnessing that compounding interest we discussed, building a substantial portfolio that can generate enough income through dividends, interest, or selling shares strategically to cover your living expenses.
Okay, that's the main one. What else?
Then there are pensions. Now, these are less common than they used to be, especially traditional ones.
Right.
But they can include company pensions. These are typically either defined benefit plans where the company promises you a certain payout in retirement, like a percentage of your final salary.
The old gold standard.
Yeah, increasingly rare though. Or, more common now, defined contribution plans like your 401k or similar plans. Here, the company and you contribute a certain amount each year, but the final amount you have depends entirely on how those investments perform over time.
So the risk is more on the employee with defined contribution.
Correct. And don't forget government pensions, like Social Security in the US or the Canada Pension Plan, Quebec Pension Plan in Canada. These provide a supplementary income source, often a really crucial baseline income for many retirees.
Good point. Not something to solely rely on maybe, but part of the picture.
Definitely part of the picture.
Yeah.
Our sources also mention inheritance as a potential income source.
Waiting for Aunt Mildred's windfall.
Hey, well, the sources offer a crucial caveat here. It's generally an unreliable source to bank on for your financial planning.
Why is that?
Well, demographics are changing. People are living much longer, which is great. But the costs of healthcare and potential long-term care in those later years are rising significantly.
So those costs can easily deplete savings that might otherwise have been passed down.
Exactly. Relying heavily on an expected inheritance is really more of a gamble than a solid financial plan. Don't count those chickens before they hatch.
It's a sobering reality, isn't it? Really highlights why that proactive planning for your own later years, starting early, being consistent, is just absolutely essential. It's about ensuring your financial security and your future choices remain firmly in your own hands.
Couldn't agree more. It's all about taking control.
So let's try to wrap this up and recap this deep dive. Financial success as a young professional, it really seems to hinge on a few key things. Proactive planning, making informed decisions, smart saving and investing, and managing your debt wisely.
That's a great summary. These aren't just abstract ideas. They are truly actionable steps you can start integrating into your life, literally today.
And some key guidelines our sources really emphasized, keeping in mind always.
Yeah, definitely. Be vigilant, watch out for frauds and financial scams. They're unfortunately really common, especially online, if it sounds too good to be true.
It probably is.
It probably is. Always understand that relationship between risk and return. Remember, higher potential gains usually mean higher potential losses. There's no magic bullet.
Read the fine print.
Always. Make it a habit. On any financial agreement, bank accounts, credit cards, loans, investment prospectuses, understand the fees, the penalties, the terms. Ignorance is not bliss here.
And avoid those unnecessary fees and penalties by just being aware of your banking terms, credit card rules, even your phone plan details. Those little fees add up.
They really do drain your resources over time, and crucially, don't ever be afraid to seek professional advice when you need it.
Even though it costs money.
Yes. While you might pay a fee for a qualified fee-only financial advisor, for example, good advice can be well worth the cost. They can help you make sound strategic decisions tailored to your unique situation and potentially save you far more than their fee in the long run by avoiding costly mistakes.
That makes a lot of sense. Getting objective advice can be invaluable when emotions might cloud your judgment.
Indeed. So maybe a final thought to leave folks with. In this world of constant financial change, new products, shifting markets, evolving regulations, true financial literacy isn't just about knowing the rules today. It's about building the adaptability, the ongoing curiosity to navigate the financial opportunities and challenges of tomorrow. So the question for you is, what will you actively seek to learn next to fortify your financial future?